Yeah, we've got like a really good lineup here of people from both well-established projects and also some what I like consider more degen DeFi optimization protocols. So I think we're gonna have a very interesting conversation here. Um, yeah, so what I wanted to start with, obviously, we can't, go into this conversation without at least slightly mentioning what's happened in the past 2 weeks, because those events, even though they're not directly tied into DeFi, they're still going to have a massive impact on what we're going to see coming in the next months. So we've had $10 billion dollars liquidity just, in some way evaporated. Obviously, the exact number is still to be confirmed. But yeah, it's going to be a big hole, and it is going to impact the DeFi. So I want to get, to start with just like your view on what's the severance of the events. I've checked some stats on DeFi Llama, and comparing to what happened in May, June with CeFi implosion, we've had like a 30% drop comparing to 60% drop in May, June, which looks less severe in some extent. But yeah, I would like to hear your opinions, guys. When they supply, do you want to start?
Sure. Yeah, I think that it's interesting that a lot of the sort of the damage that's come since June when everything started to fall apart, it's really the safer trades that have like caused the most problems, like people borrowing stable coins and then putting it into Anchor UST, or people trying to play the Grayscale Bitcoin Trust ARB, quote unquote. So yeah, I think it's like an interesting conundrum that like a lot of the riskiest behavior has been centered on the so-called like safe trades. Um, and yeah, it's something that DeFi has, I think, done relatively well at protecting against, and CeFi has not done as well. They've definitely leaned a little bit too far in and let those trades get very, very crowded and blow up.
Okay.
Yeah, I just want to mention, I think there's an important part here where the price of, or the purchasing possibility on Uniswap, you still get the best price in comparison to any sort of centralized exchange, even though we've seen this decrease in TVL and everything, right? So along those lines, the fact that Uniswap still offers best price for ETH, I mean, that's huge, right? Like the fact that you can buy Ethereum at the best price on Uniswap and it's not on Coinbase, it's not on Binance, that's massive. And that just shows how good this system really is.
Oh yeah, definitely. For me, the impact on DeFi, even though like it's going to impact the whole market, I think it's to some extent a bullish sign for us because we proved again that DeFi is much better, is working better than CeFi, and you don't see those implosions on chain. Um, yeah, Carvas, Paul, do you want to add anything?
Yeah, couple thoughts from me. I think that actually some concrete metrics actually um, benefited DeFi after this. For example, Gnosis Safe Vault. Uh, just saying that, so, for example, Gnosis Safe Vault saw hundreds of millions of inflows, which is literally like TVL that's coming into DeFi sooner or later. Ledger, Trezor, like all of the non-custodial wallets saw massive sales spikes and all of that. Of course, like a lot of different pools and TVL on major DeFi protocols went down for us as well. For example, our Curve and Balancer pools went down by like over $1 billion, just from people scrambling for liquidity and to get assets from everywhere they could. But so some of those bullish metrics sooner or later are going to come into DeFi as well. A couple other things just on the FTX situation is that FTX had a lot of usage because it was actually a great product for trading. Even though, of course, on the back end, they were doing all of this stuff, but the product itself was one of the best for that use case. And so I think DeFi still needs to catch up for that. For example, cross-margining of all of our assets there. So just in terms of the product, right, it was working very well because it was actually a great product. But yeah, the backend, which is what DeFi solves, wasn't there.
I think one of the big questions that was raised with the FTX crash is for crypto companies and crypto people in general is like, where do you store value safely? And we had the case with the company Morpholabs that is working for Morpho, or even investors in the space have been like, warning us that we should be withdrawing from centralized exchange. And then you have different options. You could open a bunch of bank accounts and go to fiat, or you could just have a safe or a multi-sig wallet with DAI inside. And I think surely like you have a big hole of 10 billions, and maybe it could have been minus 60% like a few months ago, but maybe we had also a little upside, in DeFi short term, coming from people actually withdrawing from centralized exchange or even banks and saying, hey, maybe the safest place at the moment where I can be is not a crypto-friendly bank, is not a centralized exchange, it's just, okay, let's go to a multisig. And then what do I do with this money on the multisig? Well, supply it to Compound, Aave, or Morpho, obviously. And so I think, so in the case of Morpho, I had like quite accurate metrics on this. And we had like on the week of the FTX crash, we had like plus 100 million on total supply, which was like 30% increase on what we had. So that was quite important. And a part of it was actually coming, like I would say half of it was coming from safes and InstaDApp accounts that are like, potentially like people. I'm not saying this comes from centralized exchange, but there's a good chance it could be coming from.
Okay, very interesting. So we're actually seeing some influx, from CeFi to DeFi, and not like the general exodus of LPs from the market. So that's a bullish signal. One last question on this I wanted to ask here is the longer term effect. Like Alameda was one of the biggest market makers out there, and they held a big bag of different tokens that they were, market making, and they've, taken as a SAFT. And because of the bankruptcy filing at the moment, those are going to be frozen for at least 24 months, or maybe like I don't know what the bankruptcy procedures in the States are exactly, but it is going to be a long term, and like even people from Mt. Gox bankruptcy filing, they still haven't retrieved their funds. So we're going to have those massive DeFi liquidity frozen for another whoever knows how many years. So do you think this will have an impact on the on some projects, on their liquidity, on how those token value is going to transform to the project value?
I think, of course, like you have some of these funds that, like Alameda or probably others as well that have lost funds on FTX that might have an impact, but on the large scale, I don't think that it's going to change things. I think that the more important part is that we in the crypto space and the projects in the crypto space focus on like still continuing to work and actually using these things, right? To Paul's point, like the fact that so many projects supposedly had funds on FTX instead of in a Gnosis safe is just like, why are you doing, like you're building in DeFi or in crypto, so use it. So if we're not using it, then obviously everyone else that is using these centralized exchanges because they're easier to use, that's on us. Like the fact that we're not using them, I don't know what's going on. But so I think we shouldn't really be focusing on whether like Alameda, these funds being frozen or whatever, or projects having funds frozen. Of course, it's a bad thing, but moving forward, like that's going to be a dent in the overall ecosystem. So we shouldn't be worried too much about it.
And I would say also that I assume that people are going to be assigning a much higher risk premium to operating on a centralized exchange or a centralized lending platform going forward. So where liquidity gets provided for these projects is probably going to change. Hopefully, in the coming months and years, DeFi will start having those products that we really need, order book exchanges, better cross-margining so that we can actually offer the competitive sort of experience that traders and market makers really need to succeed.
All right, cool. Oh.
Maybe something I want to add here is that Alameda and before that Celsius and other players were probably the, I don't want to say only, but of the few advanced players in DeFi that were taking opportunities or borrowing. Like we'll maybe talk about borrowing later, but I think the way it's going to impact too is that Celsius was a big borrower on Compound and Aave, for example. Alameda was too, and on Euler, for example. And it just shows that at the moment, if we don't have those advanced players, because they were like those are too risky behaviors or whatever, it puts into question some of the mechanisms that are in DeFi at the moment. And like, is there really a demand for certain use cases or certain products that we've built? And was it only maybe for those kind of players? And there's a lot of like interesting implications it can have in the space, and how, you know, real world assets could, you know, potentially be a replacement for this thing, or like, okay, but maybe we'll talk about this in lending. And yeah, and otherwise, of course, like I feel very sad for all the projects like where FTX Ventures invested in, or like where FTX was a main user. I'm thinking of Euler, for example, that have been quite impacted, I think, by the crash. But in the end, like it's DeFi, so it should be resilient to all this kind of stuff in the long term. But resilient in terms of mechanism, but then maybe it can change a lot in terms of market fit of DeFi in itself. Like it was fitting a lot those kind of players, but now is it really the product that we want to build? Those kind of questions.
Yeah, I think people's perception is going to change. Okay, let's leave the FTX behind us as soon as possible. Just journalism industry. Okay, so the next topic we're going to talk about is just, we're going to go into the DeFi liquidity, and we're going to try to dissect it a little bit. So I want to start with DEXs and see what sort of inefficiencies we've got here and how we can improve them. So like the current TVL on DeFi swaps and DEXs is 17 billion, which 9 of it is on Ethereum, which is great. I think they're still quite good figures considering the market conditions. So Squirrel, I want to start with you. If you could tell us a little bit more about Arrakis. From what I understand, you're building on top of Uniswap, and you're optimizing the liquidity provision and the yield. So yeah, can you tell us a little bit more what you're trying to achieve here?
Yeah, for sure. So what we're building now is basically market making infrastructure on top of Uniswap v3, as well as building market making strategies on top of this infrastructure. And so we're not married to Uniswap v3. It's just the best DEX out there right now by far. And we're hoping that there's going to be much more DEXs out there. But so talking about like the institutionals and like using these applications, what you'll actually find is that the majority of these kind of highly sophisticated traders or market making shops, they're actually not LPing. They're only on the buy and sell side. And that's because they can't hedge their risks, right? With an LP range on UniV3, they're just not sophisticated enough and don't understand the space enough to actually be able to hedge. So the majority of them, if they are LPing, then they're actually LPing full range, so like UniV2, because they can hedge their positions. And so what we're doing is we're basically saying, hey, we think that this AMM space is the future in some sense. We don't know if UniV3 is the end state, but we need to build infrastructure in order for sophisticated traders to be able to run strategies. And at the same time, we're building strategies ourselves on this infrastructure for things like protocol-owned liquidity. We don't think that the liquidity mining side or getting retail as protocols to kind of provide liquidity and that being your sole liquidity is not going to be a solution moving forward. I think that we're kind of seeing this ICO phase of liquidity providing, where in DeFi summer, everyone thought that them and their grandmother had to provide liquidity and that it was free yield. And now people are really realizing, oh shit, I don't know what the hell I'm doing here. And I probably shouldn't be doing it, in the same way that people realize that they probably shouldn't be the ones doing due diligence on ICO projects, and they should leave that to others, and then afterwards see whether they actually like a product, and then maybe invest in the token.
Okay, so I'm a non-technical person, so if I understand it correctly, you can deposit liquidity through Arrakis, and then what you would assign a best strategy to earn yield on that liquidity, and like move it through different LPs.
Yeah, so far our V1 product, which was kind of to see whether there was interest in an optimization product, was this. But we're kind of moving away from this now with our new products, which are going to be launched in about 2 to 3 weeks, where we think that the really important part, right, is, so if you look at the historics of it, we've so far had projects and LPers, and then in the middle there's this optimizer like Arrakis. And so what we had to do was, okay, the LPer, which is a retail investor, usually wants mid to short-term high yield. The project wants sustainable liquidity over a long period of time. So how do you actually align these goals? You can't, basically. And so that's why we're moving toward this model where instead of offering kind of this place for retailers, we're offering a place where protocols can actually provide their own liquidity, but with traditional market making strategies that are being used on centralized exchanges, we can make markets on UniV3 in a very transparent manner, so you don't have this problem of kind of having a market making deal with an Alameda or whatever and being like, hey, you're going to have a call option now and we're going to make markets, but we have no clue if you're making markets, right? And so we're moving towards this model.
Okay, that makes sense, and yeah, that definitely improves how protocols can manage, their token liquidity. Other stuff, that obviously come to mind when you're thinking of DEX is inefficiencies. It's obviously like, MEV and impermanent loss. And we can see protocols that are, resolving those aspects like CowSwap or Banker or Balancer. And but is there any like a one place which can solve everything, or do you think we're gonna, because like CowSwap, for example, they help with MEV and sandwich stack, and others are tackling the impermanent loss, and there's still like there isn't one place to tackle everything, like one to rule them all. Do you think we're getting there, or maybe are there any projects that you know of? Anyone?
I can chime in here. I think so. Let's not get into the impermanent loss discussion because everyone's gonna, like, you can speak about that for hours.
Yeah.
The short thing I'm going to say is that we're focusing too much on impermanent loss and the question of let's solve impermanent loss. You can't solve impermanent loss. So in the end, the way that like I really look at it, or we look at it most of the time, is impermanent loss is purely an opportunity cost, right? In the end, you're trying to earn yield, and if you use the simple example of going 50% USDC, 50% ETH to LP, and then you consider impermanent loss, what you really have to compare that to is taking those 50% USDC and buying ETH with it and being 100% ETH, because then that is what your opportunity cost and impermanent loss really is. So I think the discussions around impermanent loss, they're going way too far, and people love arguing about them. It's this endless thread on crypto Twitter and everywhere, right? But impermanent loss. And so I think the question is like, is that the right thing to solve? Or should we be solving like, hey, can we make a better DEX? Can we create better UX for people to LP? Can we make better UX to actually swap or trade? I think the impermanent loss question is heavily overasked.
Okay, makes sense.
I think there's also like interesting work being done. It's kind of like an emerging narrative of application-specific chains, application-specific rollups. So like you have projects like Osmosis, there's DYDX, A lot of these exchange projects seem to be like kind of interested in moving to their own execution environment, because then they can have a lot more control over their MEV and then also kind of capitalize on that and maybe return that back to the people who are really providing liquidity and providing value to the exchange. So it still seems pretty early for that, but it's an interesting kind of area for growth.
Yeah, that's going to be a good space to watch.
Can I add something there?
Sure.
I agree with you, Squirrel, that it isn't working.
Oh, sorry.
I agree that with the current designs that we have for AMMs, impermanent loss hasn't been solved in pretty much any of them. Like cow coincidence of wants, it's very interesting, but it is not the same trade-off that AMMs normally do, which is that you can just provide liquidity and then trade against a contract or against a pool instead of against other people. Where you have coincidence of wants, it's the same trade-off as a central limit order book, where you have to have both sides of the market trading at that time. But I do think it's important, and there maybe I disagree a bit. I do think it's important to think about impermanent loss, maybe not to solve it, but for other considerations. For example, my side of liquidity is that I'm a contributor at a project that needs to incentivize very heavily to have liquidity on chain for multiple reasons. We'll get into that later, and so we do need to think about what kind of impermanent loss our LPs are having. For Rapid State ETH or to STETH to ETH, it's pretty minimal. But for example, now we're looking into incentivizing stablecoin liquidity, which is something that we're talking with Iraqis about as well. And there, one of the main things is that we just need to incentivize on top of the IL that we expect people to have. Otherwise, we'll not have. And just back to the AMMs discussion, one thing that I think it's important, it's that I think it's very difficult for someone like me or anyone in the space, honestly, to have a directional opinion if AMMs are better than limit order books or etc. It's just that it's going to be tested out empirically by people providing liquidity and trading on different venues. But I think it's just a different trade-off that you're making. For example, Serum, which was a very popular order book on Solana, basically evaporated liquidity over this time, while most AMMs did not, right? So I think it's just different trade-offs where sometimes you can get better execution on order books. And even for market makers, they're much more comfortable, at least now, because that's what they're used to. Than on AMMs, but also on AMMs you have other benefits. For example, even the securitization, not that, but even the tokenization of LP positions and then using that across DeFi for other users, which is something that Aave is exploring now. For example, it's something that it's a net new innovation in DeFi that couldn't be used for capital that's market making on clubs, right? So I think it's just a different trade-offs between the two designs.
I do think it's very hard to like completely annihilate impermanent loss indexes, but I do think there's room for improvement in that field as well. Like you have a lot of actually dexes working on under the hood that are not as famous as Uniswap, but looking to reduce impermanent loss or just building derivatives on top of a Uniswap pair in order to have like single LP exposure or like less impermanent loss. So those things are possible. What you could do as well is hedging yourself. Like you have a lot of on-chain products like Squeeth or stuff like that that would be helping you like hedging yourself around the impermanent loss. And then something I find quite interesting is completely moving away from the Uniswap IMM approach and have more like a innovative order book approach. So I'm thinking in particular about Mangrove.exchange that is taking like zero liquidity provision and order book model approach, which I think is very interesting. So you have also Uniswap working on redacted, and redacted. So we don't know.
Okay, cool. Thank you very much for your insight. So moving further, let's talk about lending. So monetsupply, I wanted to start with you. Obviously, Maker, I've always been wondering, are you a stablecoin provider or a lending protocol? Because it's kind of, go into. Obviously, DAI is your main product, but lending of the DAI is also, the main activity you can think of from this way. So obviously, the Maker is, number one DeFi protocol at the moment. Just across the board. So I wanted to ask you a question. So what are the goals? I know that there is a lot of things going on, see with the end game and the whole Swift switch movement. But yeah, what are the like optimizing strategies that you see for Maker in terms of your main operations?
Yeah, I think, well, first of all, Maker, like pretty much all other DeFi protocols, is a two-sided market. So our main product is DAI, which is people supplying capital, but we also really rely on people borrowing. So we're both kind of like Compound, Morpho, other DeFi lending protocols. And I think most of the like sort of well-established DeFi protocols so far, they've really optimized for making sure that the supply side has as much security, as much safety as possible. We've seen in the past couple weeks and even earlier this year, a lot of the CeFi lenders have optimized on the other end of the spectrum where they're really catering to the borrowers and competing to get that borrowing demand, but leaving the supply side really exposed. And they ended up, largely blowing up. I can't think of a single CeFi lender that I would be willing to put money into right now. So the trade-off there is, we, at least at Maker, we probably don't offer as much leverage as we could. But then because we can really prove out that safety for the supply side, we benefit from really, really low cost of capital. People are willing to park money in DAI for, as of right now, no return. I think there's some talk about adding the DAI savings rate back, and we'll start returning some capital to DAI suppliers. Similar for Aave or Compound. Some of these really well-established, safe, trusted protocols, they're not offering as high of leverage, as much risk for the lenders as they could, but because they're so safe, they can offer really, really competitive borrow rates and really low cost of capital. I think, as we kind of get more data and we prove out kind of the limits of these systems, we'll be able to actually offer a little bit more competitive of terms. Not necessarily like under collateralized lending like the CeFi players have done, but offering people more leverage, lower capital requirements, while still maintaining the safety that is kind of DeFi's, huge advantage at this point.
Yeah, of course. That makes a lot of sense. So speaking of the big lenders out there, Compound and Aave, Paul, I would like you to tell us a little bit more about Morpho, because my understanding is like you help liquidity providers to increase their yields both for lend and borrow, built on top of those protocols. So you just basically matchmake those lenders and borrowers. Yeah, could you tell us more? Actually, I've looked at some stats, and you're coming as number 4 lending protocol on Ethereum, which is really amazing. I think you're how old is it? How old is the project?
I think 4 months.
Yeah, it's just amazing. Like your TVL is number 4 on Ethereum lending markets.
I thought it was third though.
Euler Finance is number 3.
They came back a little.
Yes, and you're just behind it, but not by much. So.
Yeah, definitely. So maybe to understand more it's important to understand how lenders like Compound and Aave work and what are the different pain points they have. And actually, if you look at the rates of Compound and Aave, you have a huge spread between the lending and the borrowing side, which is not really seen in centralized finance, like traditional finance. You have 1% to lend and 3% to borrow. And okay, this is huge, right? This is a big difference. And this is not a fee they're taking. This is just the fact that they're relying on a lending pool where you have a ton of idle liquidity and you have many, many lenders and very few borrowers because they want to preserve the liquidity of the protocol. So basically, lenders are going to share the interests paid by the few borrowers. So few borrowers are paying 3%, and many lenders are sharing the 3% into 1%. And if you look back in the last 6 months at the rates in DeFi compared to traditional finance, like we're being humiliated a little bit. I think over the last 6 months, in average, like rates on USDC on Aave has been under 1%, while in TradFi you can go like 3 times, 4 times that very easily, and on very liquid and quite safe products, to be honest. And it just shows that current state of decentralized lending is not sufficiently efficient in terms of mechanism design. This is what we think. And Morpho is basically building a lending protocol that is different in the sense that it's based on top of existing lending protocols. So if you have Aave, then you have Morpho Aave that is going to optimize Aave. If you have Compound, you have Morpho Compound, optimizing the efficiency of Compound. And basically what we do is very simple. It's like you have this 1% lending rate, this 3% lending rate, and Morpho is just going to match users peer-to-peer in the middle. So like at 2%. Okay, so instead of lending at 1, you'll be lending at 2. Instead of borrowing at 3, you'll be borrowing at 2. And so it's working through a peer-to-peer matching engine, which is significantly different from the pool model of Aave and Compound, where we're going to find a match for your liquidity that is 100% capital efficient, while on Aave, it would be like 30% capital efficient. And the thing that's very cool about Morpho is that it preserves the same risk parameters and the same liquidity as the underlying pool. So if you go to Morpho Aave, you can borrow billions, like literally the same liquidity of Aave instantly. You could also withdraw billions instantly. And you'll have the same collateralization ratio, like the same liquidation thresholds, the same oracles. Everything is the same. Literally, the only difference is the rates, because you're going to be matched peer-to-peer, and you're going to get optimized rates. So as an Aave or a Compound user, you have few interests in staying on Aave and Compound, except the fact that Aave and Compound have been here for a longer time than us. And and maybe to have few words on this and how current state of lending is not sufficiently efficient. We deeply think that it's a matter of mechanism designs and paradigms in general. Like Uniswap has done a tremendous job at finding new paradigms, and they keep doing it, that are so efficient that they start to be competitive with traditional finance. So if you look at Binance order books, like the depth of their order book is lower than the Uniswap one on most markets. And now it's for volume soon. So I think Uniswap is now second in terms of volume or something like that. So it's super impressive.
On the ETH pair, yeah.
Yeah, the ETH pair, yeah. And we don't have this equivalent in lending, I think, at the moment. And this is what we're working towards. And we do think that this is a matter of how the lending pool paradigm has been established in the past. And that has mainly been powered by liquidity mining in the past. And I was talking about product market fit for borrowers. There was kind of one market fit for those very risky users like Celsius, Alameda, and those kind of players. But apart from that, it was mainly liquidity farming. Like you were paid to borrow, so okay, you borrow, and then lenders have good rates because you have borrowers. But as soon as you remove incentives for borrowers, well, you don't have borrowers, and so rates are not so interesting. And rates are not driven by the market, but literally by the liquidity curve of Aave Compound, which is basically how they maintain high liquidity in the protocol. So yeah, there are a few interesting thoughts. I think it's a matter of mechanism design mainly. And we've been focusing a lot on token design, like the last 3 years. It had a lot of attention, but I think we should refocus on like building completely new primitives, things that are completely much more efficient than we currently have right now.
Oh, cool. I'm glad that there's a lot of things going on, and it seems like people going into Compound and Aave should move on to more for better rates. Not a financial advice though. Okay, last part that we're gonna speak to in more details is liquid staking. We've got Carvas from Lido. Lido's been miles ahead of everyone else when it comes to liquid staking, especially when it comes to Ether. Like you've got 6 billion TVL and Nexus, Coinbase, and like if you look at decentralized liquid staking providers, there's just like no one there. So yeah, my question here would be, or maybe it's 2 questions in first. So what sort of inefficiencies you see in that space, and what is Lido doing to work on to optimize them? I don't know, maybe a peg kind of situation. And also there's been a lot of kind of backslash on, because you've got the biggest market for liquid staking and you're one of the biggest validators on Ethereum, then people are not seeing it in the right way. So yeah, can you tell us a little bit more?
Of course, yeah. I have like maybe 3 points there. So first, the liquidity, right? The topic of the panel. It's basically one of the main differentiators between the different LSDs, the different tokenized representations of staking positions. Especially on Ethereum, right? On the other chains, on most the other POS chains, you can withdraw with some restrictions. So there's a primary market both ways where you can both stake new POS coins there or withdraw them. On Ethereum, you only have one, basically above one. So you only have one of those ways in the primary market, which is you can stake new ETH into staking positions, but you cannot withdraw them. So especially on Ethereum, liquidity it's one of the biggest drivers for differentiation between the quality of the different staking solutions. For us, basically for Lido, the way that has been done historically is with a massive liquidity mining program between ETH and STETH, or ETH and wrapped stake ETH. Lido has the deepest pull-on curve overall, the deepest pull-on balancer overall, and now coming up on a couple other places. Basically, there are a couple reasons we need to do that. The first one is that we need to assure people that if they ever want to exit this position, they will be able to do so with a very high degree of confidence whenever they enter the position, right? That basically reduces the opportunity cost of them entering a staking position. So basically, if they don't really have an opportunity cost there, it's free yield that they get versus holding ETH. The second one is that we need to have institutions, large DAOs, treasuries, etc., being comfortable with entering with 100 million or 200 million of ETH into a STETH position, and they can do that comfortably with the current liquidity. And again, those institutions, DAOs, etc., will be assured that they will be able to exit those positions pre-withdrawals just on secondary markets, which they couldn't do on any other liquid staking protocol, only on Lido. And then the third one is that one of the biggest drivers for growth for LSDs is integration. So MakerDAO, Aave, etc. And so to have those integrations and to have them with very healthy risk parameters, so the collateral ratio and all of that, those protocols, of course, want very deep pools and very a lot of on-chain liquidity, so that whenever there are liquidations or anything like that, it's going to be fine and it's not going to impact the price too much. A couple interesting things that we're thinking about in terms of liquidity is now opening up and starting to have liquidity against other tokens, so against other governance tokens, against stablecoins, etc. Basically to make it as tradable against as ETH itself. Then just on the last topic and outside of liquidity, the last topic that you mentioned, Lukasz, is basically on that's not really my area, but my thoughts as a contributor and as a community member, it's that Lido, just one correction, Lido is not a validator, right? You said that it's one of the biggest validators. Lido does not validate blocks. It has professional node operators that validate block with a stake that is to Lido. But my view, and of course I'm biased there, it's that it's the most decentralized solution that achieves large scale, right? So we cannot compare it with like people running validators at home. That would be wonderful, but it's just not what happens at scale. So Lido should be compared with Binance, Kraken, Coinbase, etc. And versus those, it's not a question that it's much more decentralized and much more healthy for Ethereum itself than to have all of the stake there. And that's the counterfactual. The counterfactual, it's not to have people just validating all of the stake by themselves. So that's why I'm super happy to be at Lido and very excited for that. Just one last thing is that even post withdrawals, I believe that LSTs will be the best way to stake ETH still, just because having the token representation of your position versus, for example, if you run a validator at home, you won't have that token representation. You basically literally lose optionality and collateral use that way, right? So having the fungibility of all of the stakes positions in STETH in one token that you can use across DeFi in pretty much all of the protocols, it's still better post withdrawals than. So it's not just the liquidity, it's also the use of the token. So yeah,
No, I completely agree. It just, adds another layer of the liquidity management for everyone that's in DeFi. Cool. I think we've covered the main topics for today. We've got a few more minutes left, so I would like to open the floor for any questions.
Yeah, we'll move into questions now. So if you have a question, you can raise your hand. I can give you the mic, or you can shout out if you feel like you can just speak.
Hi. So you mentioned about there being very much a retail emphasis on liquidity mining campaigns. How do you see sourcing liquidity looking like in the future? Do you see that being more a product of liquidity as a service or other kinds of strategies? So I'd just be interested to hear like your thoughts on that, basically.
You mean liquidity specifically to like trading liquidity, right? Or like
Yeah.
usage like Morpho or whatever?
Yeah, so trading liquidity, so like stable coins, Curve,
Yeah.
that type of thing.
Yeah, so I think liquidity mining isn't going to go away completely. I think that for projects that want liquidity for their governance token, I think there's much better ways than doing liquidity mining. So liquidity mining in the end is renting liquidity, right? All you're doing is you're giving these tokens so that people provide the governance token plus the base asset, ETH or USDC or whatever. And so renting liquidity is, as soon as you stop renting, that liquidity leaves, right? It's mercenary. And so we think that there's a much better model here, and this is one of the strategies that we've built, is the problem that projects have is they don't have the base asset. That's the reason why they're doing liquidity mining, right? And so they have more than enough of their governance tokens, though, and they're giving them out as liquidity mining. So why not actually use those liquidity mining tokens that you were going to use for that to actually make the market? And so with UniV3, with the nature of it and the way that the AMM works, you don't need this 50-50% supply like you did in UniV2. So what you can actually do is you can use 95% governance tokens and 5% base assets, right? And as the market moves, you can actually start providing liquidity with that capital, and then with a strategy can actually move to a 70-30 or 50-50 ratio, and then just have the market be made like that. So the protocol, of course, like we know Olympus Pro in terms of protocol and liquidity, the problem there is that you're basically selling these tokens at a massive discount, right? And so here what we're saying is, hey, use those tokens that you're going to use for liquidity mining or for protocol and liquidity directly in the market to actually have liquidity, rather than giving them to mercenary capital that's just going to dump your tokens and going to leave as soon as you stop.
Any other questions?
There's another one for you, Squirrel. With big players like Alameda leaving the space of liquidity mining, there's going to be like echoes in how efficient the market is. What do you think that means for the future in the next like 3 to 6 months for DeFi and providing liquidity to LPs, for trading LPs, that is?
Yeah, so I think this kind of comes back to my point from before, where I think people are now starting to realize that the liquidity mining incentives that they've been getting doesn't actually offset the IL, right? And so people are going to start realizing, like, damn, I'm getting wrecked with LPing. Like, I thought I was getting rich, right? That's what everyone was thinking. They're like, oh, free money, like free yield, like it's so good. I can be a market maker. Every market maker makes money, right? But market making is difficult. Like the margins in market making are very low on centralized exchanges. And that's going to be the same case in DeFi, where the yields are going to start going lower and lower, right? And so because of that, I think that more professional actors will come in. I speak with market makers on a weekly basis that are doing stuff on the centralized exchanges, and of course they see a massive need to move to DeFi as well, because they see that volumes are shifting here. And so I think that sophisticated traders, sophisticated companies are going to come in and going to help more in terms of actually making liquidity providing more efficient, right? And already with UniV3, it's become much more capital efficient. But if you then have actively managed UniV3, or you have a central limit order book or whatever, then we're going to see much more efficiency there. And retail will still be able to LP. And I think that's the beauty of this, right? The fact that retail can LP, or on UniV3, you can open up a single-sided position, right? Like to dollar cost average it into ETH or dollar cost average out of ETH. So that's beautiful. But I think that we do just need more sophisticated actors, and they're coming.
I think we have time for one or two more. If anyone else has a question. And then we'll move into a break after this. So if the panelists want to stay up and answer more questions, you're welcome to.
Okay, I think there's no more questions, so let's wrap this up. Thank you very much, guys. It was a pleasure to speak to you and learn from your expertise. Yeah, look forward to more chats. Thank you very much.
Thank you.
Thank you.
Thanks, y'all.